Well, welcome. It's September 18th, 2025, and wanted to thank you all for showing up to the 18th webinar. I know someone's going to fact check that, make sure it is the 18th webinar, but we're going to be talking about what I think is a very exciting topic for the Rosedale Family Office. And that's the investments and the implications of AI. I apologize, I just choked in the camera. But this is a live feed, so you never know what you're going to get here. Anyways, I'm fascinated about AI. I'm not sure what you've been thinking or what you've been reading about it, but it is an amazing technology that I think is going to change. It's going to come faster. Changes are going to come faster than I think we all think about. In terms of investing, I was listening to Tim Cook the other day, and he was fascinated as well by how fast things are changing. He said he's never seen this in his life, and he's been through a couple of changes with respect to technology, and he knows what he's talking about. So I'm actually excited to see what happens in the next 10 years, and it's going to be interesting. I think just the way that we change our lives. It's and all the different things that it's going to affect with respect to research and changes to the way that you operate. I even think about it, just the other day, Sarah and I were trying to, plan a vacation. Well, we used ChatGPT to put some things in the vacation. Next thing I know, we had an itinerary perfectly laid out for us to go skiing in Austria. And I just couldn't believe how detailed it was, right down to the restaurants. And, I thought, well, maybe it's going to pick my food for you and we wouldn't have to do anything. But I actually enjoy picking food, so we're not going to let that happen. Anyways, today we've got Noah Durfeld, who's going to be asking some really tough questions for Himalaya Jain. Sonny Singh, it hasn't even been a year yet, Sonny, and you're picking a couple of winners out there in terms of some stocks, so you're doing a great job. Really appreciate your input, and it's been a pleasure having you on board. So I want you to listen. I think we've got some great questions. I look forward to hearing you guys and telling us what we're all going to learn about AI. And I think one of our biggest positions is probably Google, right? So Google, there's your AI story there. It was so fascinating. Like, the thing was down to like $180, 160, and then now it's up to 240. It continues to be a great stock. You've got Tesla, or not Tesla, but a Tesla Light. What's it called? Waymo. Waymo, where you drive. Actually, I was in Austin, Texas, and I watched these cars just drive by themselves. That's why I think AI is just going to be fascinating in terms of the next little while, and it's going to move fast. So everybody, hold on to your seats. We've got a great session for you, and I look forward to hearing what you guys have to say. So I'm going to put it over to you guys, and Noah, don't be nice. Make sure you ask some tough questions.
I've been waiting for this chance to stump them, Gord, so no worries there. And just a few housekeeping things for our audience. If you have questions that come up during the conversation today, feel free to put them in the chat in the webinar or text them to your relationship manager at Rosedale Family Office, and they, using the power of AI, will text them directly to me, and then we'll try and stump Himalaya and Sunny with it. As you might see, we're trying a bit of a new setup today. The three of us are in one room, using three different microphones, but all together, so it'll be a little bit more conversational. So please bear with us if there's any technical issues, but we think we've got it all sorted. We've got a great technical team here, and they got us all set up with about 30 seconds to spare on the webinar. One other shout out, we had an awesome episode of our podcast released in the last few weeks. Sunny, along with a few other members of our team, put together a really great episode of the Redefine Your Wealth podcast on what's been happening in markets. And we will be releasing episodes of that podcast monthly going forward. So if you liked the most recent episode, tune in monthly to hear Sunny and other members of the Rosedale Family Office talk about markets and everything that goes into making sure your portfolios continue to go up. So as Gord said, the big conversation for today, Himalaya and Sunny, is AI. You hear it in the news a lot. We see it in our daily lives. And a lot of the questions that we're getting is this a future shaping technology, or are we in the midst of a bit of a bubble right now? And I know you two think about this and talk about this a lot. So I think it's an awesome opportunity to really talk to clients about how we see AI and how it fits into the investment landscape. But before we dive into some of those details, maybe we can just take a step back. and you can tell us a little bit about what's really changed in the last few years, because AI has been a topic of conversation for decades. It's been in science fiction for longer than that, but it's really becoming a reality now in the last year or so. So, what's caused that?
Yeah, that's a great place to start, Noah. Rather than talk about the state of the art today, and you're right, it is very. It has its foundations in science fiction. Um, I remember watching, as many of our viewers probably remember watching 2001: The Space Odyssey, which was actually filmed in the 60s, and it was based. It was supposed to be based in 2001, and if you remember, in that there was a computer named HAL, who was a computer, but through the movie developed artificial intelligence and started thinking on its own. So that's and the concept of AI has existed even before that, but it has been the subject of science fiction up until recently. So before I get into what's happened in the past few years, what is AI? It's essentially a computer system that does what the human brain can do. It can reason, it can think, it can make decisions. And when you think about that, despite all the computing power, we're not there yet. AI is not fully at the point where it can be autonomously making decisions and reasoning the way a human can. It can assist, it can help us summarize, but it is still not at that stage yet where it can truly operate autonomously. So with that in mind, what's happened in the past few years, because when we think about the last 5 years, we had the pandemic 5 years ago, and coming out of that, a lot of technology stocks started performing very well, mainly because you had workers and children, doing schooling online, working online, and AI kind of just snuck up on us. And three things came together that didn't exist in the past, and those three things are fast computer chips, data, and algorithms. And it's really the confluence of those three that have come along at the same time that have allowed uh, artificial intelligence to get to where it is today.
Yeah, that's really interesting, and maybe relieving as well to hear that we're not about to get robots taken over anytime soon. Like some of the worst nightmare scenarios from science fiction aren't yet realized. Um, but like even the AI that we're seeing today has, from what I'm seeing, some vast consequences for how we live our lives, how we work, how we interact with our technology. So, what are some of those consequences, even if they're not the full science fiction version yet?
Yeah, so when we think about there's a lot of positive attributes as well, but when we think about consequences, you're right. It's very easy whenever there's something new. It is tempting to fear change, and when we think about disruption that can potentially come from AI, the potential is enormous. However, we like to think about AI as a potentially transformative technology. No different than previous transformative technologies in history. So think about when the internet first came along, or think about when the first internal combustion engines came along. They caused a lot of disruption. There were a lot of industries that were wiped out, which eventually gave rise to other industries. So we may be on the cusp of another phase of disruption. However, if we use history as a guide, what will eventually come out of it are likely jobs, applications, industries that we don't even know about today, as what has happened in the past.
I think job loss is one that many are talking about. It's all over the papers. How AI is going to eliminate a lot of the more of the entry level jobs. And like Himalaya said, we've seen this time and time again. If you look at farmers 100 years ago, right, that took up a large part of the population when it came to employment. Then you had heavy machinery come about, and obviously reduce the labor intensity of farming, meaning need less people to do that. yes, there were job losses, but then those people went on to either learn new skills and services within the farming industry, so new businesses developed, but also just leaving the industry altogether and creating new ones. So there's definitely opportunity there. What that will be, we're still figuring that out, obviously, but I think history will repeat itself in this case.
Yeah, like you think of some examples, like Gord mentioned off the top with Waymo and some of the other self-driving cars, self-driving trucks, like potential to disrupt that whole industry of ride sharing and truck driving, which employs a lot of people. But I always go back to that stat that even through all that disruption and some of the past technology changes that you discussed, Himalaya, even though in the short term it caused job loss, in the long term it actually created more jobs that were lost because of all the new opportunities that were created. Um, so how do we go about thinking about what some of those new opportunities might be?
Yeah. And that's the right frame to think about it is, um, this is a journey, and as with other transformative technologies, it doesn't happen overnight. And while it's happening, it causes a lot of anxiety, a lot of uncertainty, a lot of disruption. But when we think about, uh, again, what's happened in the past and what may likely happen is if AI can take the place of lower value added jobs in the economy, that lifts the value add that everybody else is doing. And that is exactly what has happened in the past. The way economics has measured this is productivity. So productivity is simply the amount of output that a single person can produce over a given time period.
Mm-hmm.
And time again, transformative technologies have caused productivity to rise. So there's no reason to think that AI won't do that again. It's going to lead to productivity gains. Of course, it's going to cause disruption in the interim, but ultimately, what that means is for every hour worked by workers, that there's going to be greater output. So essentially, it makes not just individuals more efficient, but it makes the economy more efficient. It leads to greater GDP growth for the economy. And again, that's been the experience.
Right.
It's to be seen whether we're actually going to see that transformative technology or whether this will be an incremental type of technology.
So how do we at Roselle Family Office and how should everybody assess new technology waves to try and determine whether or not it will actually lead to that increased productivity? Another big technology wave that we've seen over the last 5 to 10 years, which we got questions about all the time, and we've been very vocal at Roselle Family Office about not buying into and not investing in, being cryptocurrency and Bitcoin and some of the other currencies specifically. That's a technology that we didn't necessarily see the productivity benefits from. So why are we looking at AI differently, and how do people assess those types of technologies for themselves?
Yeah, that's a great question, and not a easy one because again, we don't have all of the facts. We don't know what the end um, result will be, or what AI will ultimately be able to accomplish. So from a investment perspective, how we've chosen to approach it is, as we've done with most investments, is not speculate. And there are small companies involved in AI. There's very large companies involved in AI, and there's there are some big winners. However, we've decided to take a more measured approach by investing in companies, as Gord mentioned, Alphabet. Perfect example of a company that is vertically integrated within all of the pieces of AI. So
Right.
They are making their own chips. Of course, they have their own data centers and cloud computing capacity, and they are also making their own algorithms. And just this week, an interesting fact was their AI product, their chatbot, it's called Gemini. It actually overtook ChatGPT as on Apple's App Store as the most downloaded free app. So that's an example of a investment that we've held in the past, and we've actually held on to it, not just because of their legacy business, but their evolution into AI, knowing that they've got an incredible balance sheet, throws off a lot of cash flow. So it's a lower risk way of approaching AI.
We're also, I mean, we're depending on those with far more expertise than ourselves, right? There's a story that has been told many a time by one of the portfolio managers of one of the funds that we own. His name is Mark Schmel, and he runs the Fidelity Global Innovators Fund, which again, it's a widely held position in our models. And he tells this story of, he's a Canadian-born portfolio manager, but he moved to San Francisco years ago. And he likes to tell this story, whether it's himself or his associate. I think it's kind of blurry there, but either one of them were walking down the street in San Francisco, and they saw a sign, a flyer essentially, for a AI conference. He had no idea what this was about, but he decided to attend it. So he got there, it was a zoo, but it was all the who's who in AI. And from that moment, he decided to learn everything he could about AI. And that drove him to make one of his biggest and best calls ever, buying NVIDIA very early on. He's a big believer, obviously, in AI, and he's continued to tout many other stocks. But it speaks to the importance of having boots on the ground. Right. We're here in Toronto, thousands of miles away from where a lot of the big technological advances are occurring down in California. To have him down there in the midst of everything is a huge value add. That's why we use him for our models. I mean, Himalaya and I could try to find the next Google or the next NVIDIA, and maybe we'll get lucky and do that. But this is his full-time job to do. So we're definitely leveraging his abilities.
Yeah. Sorry, go ahead.
Yeah, and actually, just on Sonny's point, he because Mark Schmel is so tapped into the technology ecosystem in Silicon Valley, he has access to private investments.
Right.
So he's able to invest in companies that we can't even invest in because they are simply just not public. They don't trade. OpenAI is a perfect example that he's got an indirect investment, and that is it just benefits our clients because we have access through this fund to everything cutting edge that's going on in AI.
Right. So in some previous technology revolutions, let's say just like with the advent of railroad that you mentioned earlier, there was this saying that you don't want to necessarily invest in the railroads, but you want to invest in the picks and the shovels, the things that actually build the railroads. So you had mentioned three components to what's caused AI to be successful in 2024 and 2025, the data, the chips, and the algorithms.
Yep.
Is that a similar kind of approach to the picks and shovels, where instead of investing in the AI companies, for example, like a Perplexity or something that actually is putting out an AI model, we should be looking to invest in the picks and shovels, so to speak, or the data and the chips? Or how do we think about that from an investment standpoint?
Yeah, that's a great analogy, and it applies to not just railways, but it applies to electricity or even the automotive industry. So, when a new transformative technology emerges, there's a lot of excitement about the people that are laying the track. And there's a lot of investment that goes in. There's a lot of speculation as well. What history taught us time and time again was the initial phase of investment and capacity building, it tends to overshoot. And think about the late 90s. You had the internet boom was on. And the companies that had the highest valuations and the most excitement were the ones laying the tracks. Right. It was companies like JDS Uniphase, it was WorldCom, it was Global Crossing, it was Nortel. They were building the infrastructure, which is very, very important for the internet. However, when was the last time you heard about any of those companies? But in
Canada, we hear about Nortel just in horror stories.
Yes, in horror stories, I agree. But what they laid the foundation for was what came next. Without that infrastructure built, you wouldn't have a Google or a Facebook, or you wouldn't have e-commerce that powers Amazon. So when we apply that analogy to AI, I think the phase that we are in, and who knows whether it has climaxed or not, is we are in that heavy investment stage where the infrastructure is being built. ultimately, as with other technologies, it's the application of the technology that will lead to the productivity gains. So think about a bank. Has nothing to do with AI. They're a financial services company, but there's plenty of applications that they can make to make their business more efficient, boost margins, increase profitability, and ultimately result in their share prices rising. So it's the short term and then the medium term and the long term that we have to think about. And we're probably still in that early stage of development right now.
I think you hit on a very good point there, Himalaya. I mean, people always think about, when they're thinking about AI, they should invest in the big tech companies. It's not always the case. Sometimes it's the steady, boring companies like the banks that can efficiently implement AI, enhance their business services, and drive that profitability. Like, I was lucky enough to work across 3 different business lines of several of the big banks over my career. So I've been able to, I can see firsthand how this is going to help the banks, from contact centers, eliminate the majority of the staff there. A big one is credit risk underwriting. Using AI and all the amounts of data the banks have to better underwrite risk is significant, because credit losses are obviously an important part of their business. And then the list goes on. So I actually wrote a report about this years ago in my past life about AI and the banks. But most people don't associate something fun and exciting as AI with something as boring as the banks. But this will have ramifications across all industries, and we need to be aware of that and look from a portfolio manager perspective, consider those industries.
Yeah. So picking up on that, and I want to tackle this next part of the conversation kind of from 2 sides. When it comes to both our portfolios, but also just the investment universe in general, you can imagine some companies, some sectors, some industries that are going to really benefit from AI, and also some that will be disrupted and be left to the wayside from AI. So how do we think through both of those outcomes and make sure that we're avoiding the areas that are going to be disrupted? Or investors in general, how do they think through avoiding the areas that will be disrupted? And how do we make sure we're benefiting from some of the efficiency gains that you just talked about, Sonny?
It's a tough one, right? But that's a very tough one. And we're probably
I guess if we knew perfectly,
we're probably not going to get them all right.
Yeah.
That is for sure, right? It's just, you just looking at companies that have operations where clearly technology will have a benefit if it was just implemented properly. Again, I can't tell you today which one's going to be the ones that go under or the ones that succeed. But again, something like the banks, I think, could do very, very well. Himalaya, if there's other sectors that you think.
Yeah, and when we think about where we do have concentration in the portfolio, it can be a service where AI may not have a positive or negative impact. So think about Enbridge. It's a pipeline. It's transporting energy, and for the foreseeable future, it's relatively immune from, it's not going to benefit, nor is it going to get hurt. But I think about another position that we have in many portfolios, Element Fleet, where what their business is to make trucking companies more efficient. And so that's where data science is being used to not just calculate what is the most fuel efficient route in real time for companies operating fleets, but it goes right down to managing their personnel. So there's an example of a company that will benefit. So hopefully we don't own too many that are going to be hurt from it, but we're constantly looking for names in the portfolio. And as companies themselves are seeing AI and how they can use it, they are speaking up now. So in their quarterly conference calls, in their annual reports, they are starting to highlight where they are implementing AI and some of the efficiencies that they're finding. So that it's a learning process for everyone. And again, it's a journey. And we're very cognizant that there could be some pitfalls there, but hopefully we avoid most of them.
So we're going to move the conversation and broaden it out a little bit to talk with the market in general. But I think it would be fun for our audience if we do a quick speed round. We'll go around the 3 of us, and I want you to tell our audience what's one interesting or fun use case that you've used in your own life with AI, and what was the AI tool that you used for it? Because that's a question I get all the time. Like, sounds great, AI in business and all these efficiencies, but how does it actually impact me? So, how have you two been using AI? And I'll go last.
I use it all the time. I love it. And I actually pay for the premium version of ChatGPT because I hate when they tell me that my limit is up. I use it that frequently. Gemini, though, is an excellent chatbot as well. But similar to what Gord said, and been on 2 trips down south. Don't hate on me for that. But in the last month and a half, and I've used AI both times, ChatGPT both times, to fill out an itinerary for the entire trip. South Carolina, for example, I said I have 2 young kids, 6 and 3 years old. We're going to be staying in this location. Please give me a day-to-day itinerary of what we should do to keep them occupied. If it rains, give alternatives, and it laid out a complete agenda from start to finish. Drive times in between locations, where to eat in between locations, depending on what my kids like to eat.
Right.
It's phenomenal. The time saving.
Cool.
I remember when I was younger, my wife and I we would Friday night, we'd pour a glass of wine and we'd sit in front of the computer before a big trip just to plan all that. It would take hours to plan our hotels and our activities, and now it's literally a hit of a button. It's incredible.
It's awesome. How about you, Himalaya?
I've got several examples. I know Gord mentioned Waymo. Earlier this year in May, I took my parents to San Francisco. My dad who's in his 90s, he said, before I die, I want to see giant redwoods. So we did get to see those. But in San Francisco, we rode those Waymos. And that is, artificial intelligence on wheels. It is amazing, just sitting, not just as a passenger, but just viewing the screen, that you're kind of seeing what the car is seeing. And it was interesting seeing everything color coded. So if there's a pedestrian, they show up as a different color. If there's a dog, it'll be a different color. If there's a bicycle, it'll be a different color. So the computer, the cameras and the sensors, they look at everything and they interpret, oh, that's a mailbox, that's a person. So they're able to, in real time, say that, well, if this is a bicycle, it's probably moving at a faster speed than if this object is a person.
Right.
So it factors all of that in calculating how fast it should go or what lane it should be in to anticipate, oh, this bicycle might do this.
Right.
So that's one example. A fun example is I belong to a book club, and I'm always, of course, I read every book. I don't cheat. But before the book club, because by the time we meet, I've already read 5 other books and I forget about the book. So I'll do an AI summary, like literally on my way there, on my walk, and I'll just say, give me a summary of this book and some character development about this person or that person. And 10 minutes later, by the time I get to my book club, I sound like a genius.
Oh, man. High school English class is going to be so different in the future when kids don't have to actually read the books.
That's right.
One for me that I think is fun, and I didn't actually know you could do this. My wife taught me, so this is a good one for all of you out there. If you're ever out shopping for something and you, like furniture or clothes or whatever it is, and you find a brand name piece of furniture, for example, and you look at it and you think, this is really nice, but I don't want to spend for the brand name at wherever, you can take a photo of it and upload it to ChatGPT or one of the other services and ask it to find you a similar piece of furniture for sale in your area. And it'll scour all the websites, IKEA, like wherever, and it'll find you 10 or 15 different pieces of furniture that are very similar to the one that you upload the photo of. And often it's at a much better price. So I use that all the time now when I'm out and about shopping, and it's saved me a lot of money.
Here's a good one I just thought about. This I did a year ago, though. So
Okay.
It's been around for a while. But for those that enjoy a nice Friday evening cocktail or beverage, you don't know what to make. I one night took out like 4 or 5 ingredients, put them on my shelf, on my counter, took a picture, and asked ChatGPT to give me 3 recipes in a second. It just
Were they good?
There were a couple that I knew about already, but it's still pretty neat to do that just from a picture.
Well, you might have to make us one of those after this. But let's move on to the broader market conversation. I want to start this just with kind of level setting where we are at in markets. And one of the times that you hear AI brought up is in the context of a bit of a market bubble. People see markets going up every day, every week, and valuations are starting to get a little bit stretched, and some market participants are starting to get worried that things are too expensive. So, Sonny, maybe you could give us a bit of a level set of the state of markets right now and where we think we are in the cycle.
Yeah, it's been quite the year. If you went to hibernate at the end of 2024 and you woke up today, you're probably pretty happy with your portfolio performance, but you had no idea the roller coaster ride that it took to get us to this point today, right? We're doing very, very well, especially us here in Canada, where the market's up about 20%, far outpacing the S&P 500 and the NASDAQ. But again, it's been extremely volatile, and the biggest reason I think for that is obviously tariffs and trade concerns for the first 9 months of this year. It's becoming more clear that initially when these tariff announcements were made, that companies were kind of eating the bill here, I guess you could say, but now it seems like more and more companies are starting to pass that on to the consumer. So that could have an inflationary effect, particularly, I feel like in the U.S., obviously.
And have we seen that start to show up in inflation data? I know it's been a little bit mixed, but
where are we Canada has been better than the U.S., that's for sure. Our inflation rate has been lower here. We just here in Canada actually reduced or eliminated the counter tariffs against the U.S., so that should help keep inflation in check as well here in Canada.
Right.
But things like the de minimis lifting of that benefit has been a big issue for retailers. Essentially, that any good that's under $800 wasn't tariffed in the past, and now it is. So you're seeing quite an impact on some of the retailers, and they're coming out and they're explaining that in their quarterly results, which are catching some investors off guard. The economy obviously has been, the job market has been a little bit weaker than I think people thought it was just a couple months ago. In Canada, we had 2 straight months of, I think, job losses. Our unemployment rate is at 7.1%. But the bigger surprise was the United States. When we got the jobs data last month, it was weak. But what was the bigger problem was the revisions for the prior 2 months, which, again, investors thought that the U.S. labor market was doing okay. This clearly made it very, very clear that it's not doing as well as we initially thought. And that, I think, opened up the door to what we received yesterday, both in Canada and the U.S., and that is a 25 basis point rate cut on both sides of the border. Does that continue? I mean, the market is expecting further rate cuts in the U.S. They're expecting further rate cuts in Canada. I think with Canadian inflation a little bit more in check, and our employment picture a little bit worse, we might get more here. Let's see how that goes. But we also did get started earlier on interest rate cuts in the United States. So that'll be interesting to see how that all plays out. The housing market on both sides of the border has been stalled, really, because rates have been so high. Many are expecting the market to pick up, the housing market to pick up, and that could generally has a flow through to the rest of the economy, which could hopefully be a positive. But to your point on why are markets at all-time highs when there's so many different concerns out there, I think we have to really remember that the market is a forward-looking mechanism, right? It likes to look 6, 9, 12 months out. And, it's been suffering through the tariff noise for the last 9 months. And now I think it's looking at the benefits to come, like tax cuts, deregulation, domestic U.S. investment, lower interest rates. These are things that are, could be and possibly could offset a lot of the tariff concerns that are out there. So I think that's what is driving market optimism. Now, look, we are invested in the market, we're participating in the market, but we have to be, aware that valuations are elevated. So what we're doing right now in our portfolios is, as positions become what we call overweight relative to our target, we're trying to pare those back, hang on to the cash, put a little cash into fixed income for that eventual or potential pullback where we can put money to work in better opportunities. I don't want to use the pullback term too often because what is a pullback? 5%, 10%? It varies by what your definition is, but even something like a 5% pullback would give us an opportunity to put some more cash to work.
Yeah, it's you look out in the world, you read headlines, see what's happening in the U.S., and a lot of people get the sense that it's not a normal kind of year, normal news cycle. But in many ways, it's been a very normal market year. Every year, you kind of expect a 5 to 10% pullback at some point, which we got earlier in the year. And then overall, you expect markets on average to be up 7 to 10%, depending on the year. And that's more or less what we're getting again this year. So should we expect the market to continue behaving normally? or is there some disconnect right now between markets and what we're seeing in the news cycle?
Yeah, I would just reiterate what Sunny said. Markets are forward-looking, and if you boil it down into very simple terms, the market or share price is earnings times a multiple, and earnings have been very, very resilient. And even last quarter is a perfect example. Expectations were that a lot of the geopolitical and tariff noise would hit earnings, and yet we came through it with flying colors on both sides of the border and even internationally, frankly. And heading into the end of this quarter, which is just a couple of weeks away, we haven't seen a flurry of downward revisions when it comes to earnings estimates. So, and looking into next year, the expectation is that earnings are going to increase by that mid to high single digit range. So long as earnings are intact, and you have some tailwinds in the form of lower interest rates, fiscal stimulus, pretty well all over the world. As long as you have those broad tailwinds, and then you have this thematic theme that we've been talking about, AI as a source of potential margin expansion, that is really what is the basis of this optimism in the market.
Right.
And so to answer your question, I don't see, other than short-term blips, I don't see that being derailed in the near future.
Yeah, and like we've talked about for a long time, and like Tony, you just reiterated, we're always looking out 6, 12, 18 months, and that's our investment horizon. So how are we positioned right now in anticipation of that kind of 12 to 18 month future? I know each client's different and all our models are slightly different, but just in general, are we on the more aggressive side? Are we being a little bit defensive? How are we positioning for the future right now?
Yeah, so again, we're fully invested. What that means is that we're hanging on to very little cash.
Yep.
We do have a fixed income allocation, but we are, I'd say, modestly overweight equities. And what that means is in the US, we're overweight. And in Canada, we have a slight overweight. International, a little less so.
Mm-hmm.
That's where we're a bit underweight. But overall, we're constructive, and that's why we've got that modest overweight position in equities. And don't get me wrong, if we start to see cracks start to develop, and if those cracks mean that corporate earnings are vulnerable, that would be a sign for us to start to pare back some of our equity exposure. But I'd say right now, yeah, we are overweight equities. We think that holding cash is not as attractive right now. Again, it comes back to that broader themes, and these tailwinds that we've got.
Mm-hmm.
We're always keeping valuation on the front burner, and whenever an individual position gets too expensive relative to its peers or relative to where it's traded in the past, we pay attention to that.
Do either of you have any last comments on general markets and what's been happening in the economy before we switch to Q&A?
I've got a funny anecdote that, again, it kind of comes back to where we are with AI.
Yep.
And this anecdote, it's a true story. When the first trains were being developed and a very new locomotive had been invented, and it was the grand opening of the Liverpool to Manchester railway line. And the local MP and a lot of other dignitaries came out to mark the occasion. And the local MP was hit by the train, and he died. And I'm using that as an example that when a new transformative technology comes along, you don't know what to expect. And he saw the train; he just didn't realize that it goes so fast because he had never seen anything go that fast.
Right.
So as we think about that and apply it to today, things are changing very, very quickly, and we have to pay attention. We have to respect what is happening. We have to be on top of it. We don't have to we shouldn't be hiding from it. But at the same time, we can't be complacent.
I think that's a great anecdote. Good reminder to not stand in front of the train.
Don't stand in front of the freight train. Yeah.
Yeah. All right. So just a call to our audience. If you have any questions about anything we've talked about today, please put it in the chat. I'll have them fed to me by our amazing AI system in the back. We call him George, and he does everything automatically. So he will text them right to my phone. But we'll start out with a question that I got earlier today from a client that they wanted me to ask, which has to do with something near and dear to all of our hearts, the Toronto and generally the Ontario housing market. Lots of people are talking about it as if it's a buyer's market. We just saw another rate cut yesterday. So what's the current state of housing in our lovely province, and when should we expect prices to kind of stabilize and stop being a buyer's market?
Yeah, I can take that one. Look, it's as simple as supply and demand. We came through those early pandemic years with lots of demand, both because population growth, but also because interest rates had just been dropped to zero.
Right.
It spurred a lot of demand, and prices started to rise. And what happened was the supply responded, the developers, they responded by turning on the taps and starting to build. So what we're seeing right now is, that imbalance, just as it was a imbalance 5 years ago of too much demand, not enough supply. Now we've got too much supply, not enough demand. And eventually, this is a classic cycle where right now we're not seeing any new supply come on in the form of new shovels going in the ground. And when we look out 2.5, 3 years, once the existing supply gets absorbed, we'll be back into a shortage again. And that's when prices should start to rise. So this is not, although it must be painful for some people seeing prices go down, but that is very much just a part of a natural cycle of supply and demand. And I would put it at 2.5 to 3 years of when we should start to see prices start to move higher again.
I think, Himalaya, you can even relate that to the commercial office market,
Yeah.
right? I mean, everyone left that one for dead during the pandemic, with companies obviously letting go of square footage because the employees weren't coming to the office. And now you're seeing the major banks and other corporations demanding 4 days or more into the office, right? And you're seeing a lot of the office REITs really start taking off again when everybody honestly left them for dead. So yeah, that's again another anecdote here in Toronto where things are starting to improve just a little bit.
Okay. Next one's a bit of a spicy one. So there's this concept in investing that's called different things, but known as sovereignty risk or sovereign risk, where when you're investing in certain countries, you need to take into account some of the government interventions and how that might affect your investment. Is that something that, given the political situation in the U.S., we're starting to consider as how the government might impact the investments that we're making?
I'll start, Sonny, feel free to add on. Yeah, look, there's a lot of reasons to dislike, if I can say it politely, what's going on south of the border. But it's still, for all the reasons that we talked about today, it's still a very important market to be investing in. That is where a lot of the technological innovation is happening. How we've addressed it, and it's actually worked in our favor, is what Noah's referring to is when a country or its bonds or its ability to pay starts to deteriorate, it shows up in the form of a weaker currency. It shows up in interest rates in that country being higher relative to other countries. So that's a risk that we've been willing to take, and we've addressed it in our portfolio by hedging out some of the currency risk on some of the positions. And I think we've talked to many of our clients about that in the past. So I'd say that's there is some clear risk, and it's actually been experienced this year already with the US dollar down virtually against every single currency in the world, but we've been able to manage that just through a hedging program.
That's great.
No comments, Singh?
Nah, I mean, without getting too, it's a sensitive topic. There's no question.
You can always
right?
pass.
I'll pass for now.
All right. I think last question, just given the time, and Gord is going to be so happy that we got this question in. But one of the reasons that the TSX has done so well this year is because the strength of commodities, specifically gold, but also others like silver and palladium. So what's going on in the gold market, and why do we not own gold stocks?
I can start with that one. There's been a ton of discussion on the desk about gold. I feel like we talk about gold every day as the equities continue to go higher. For me, gold has always been an asset allocation decision. So if you want to buy gold, you're buying gold to hedge against risks in the market. And so to me, the way to do that is you buy the gold bullion and you have a fixed percentage, and that's, you leave it at that. What's really going on now, it took a couple of years, but the gold miners are really starting to rally, and that's really propelling the TSX to levels that we're seeing currently. That's a tougher one for me, or those that are on the call that have been investing for decades understand that, gold typically has been a significant destroyer of capital over time. Management teams haven't been the best stewards of capital. You could argue that was the same for the oil companies as well, but now they are, they found religion and that they are actually great stewards of capital. I'm not sure the gold companies are there yet. That being said, having some gold exposure is a great insurance piece that many clients can definitely take advantage of. I just do think I'd rather buy the commodity than the equities.
All right. Himalaya, anything on that?
Yeah, I would just say, look, if I could go back to January and I knew that what was going to happen this year, first of all, I don't think anyone could have predicted what was going to happen in 2025 geopolitically. It would have been a no-brainer to buy gold. But what we've always done in making our investments is, look at the outlook and how predictable is it? How are things valued? What's the opportunity for upside? And there has always tended to be greater clarity and easier narrative to build on a company like Alphabet. You know that they're growing earnings at a double-digit rate. We know the valuation. We know what the breakup value of Google is in a downside scenario. So we tend to invest in things that we know we can look ahead and with a fair amount of clarity see that this company's going to do really well. Or if it's a company like Enbridge, we know that they're going to continue to pay a very attractive dividend. Gold has done really well because a lot of bad things have happened this year, which again, it's been more of a guess rather than something that we can predict.
Right. The one offset to that I would say is that I don't think that anyone had expected the amount of central bank buying of gold over the last few years. And the reports that I've read, I think that is supposed to continue, especially as there's more concerns about the U.S. de-dollarization. People are starting to buy gold to hedge against some of that. So you could see gold being supported at these levels. I fully believe that. But from an equity standpoint, how much further can they go? It's a question mark.
Awesome. Well, thank you both very much for joining me today for this awesome conversation. As we said, this was a bit of a new format. So if you like the more conversational style and all of us sitting in one room like this, let us know if you think we should do this again or if we should revert back to the old way. We're just trying new things here and hopefully our audience likes it. I think we still have Gord on the line. We're going to call him in for a last goodbye to you all. Thank you very much.
Sorry, actually, it felt like I just saw a picture of me on the screen there. It looked like I just woke up. Anyways, no, I'm just kidding you. Actually, that was excellent, guys. I just want to thank you for your stewardship during these periods. I mean, I started going through the year. I don't think anybody thought April 2nd was going to happen, and that's when the tariffs came into effect and everybody panicked. It turns out maybe tariffs it's not as bad as everybody thought it's going to be, and then so that's all changed. But we managed to sort of manage through that. And I think you're beating yourselves up about the gold. I don't think that's the only thing that you own. What's great about a diversified portfolio would be, the ones that you do own and some great stocks. We've got like an 8% or maybe it's a 5% position in Google or Alphabet, and it's done phenomenal. And the other stock that I really like is Citi. And I don't know if, many of our people out there don't realize that Citi has gone through the roof this year. It's one of the best performing bank stocks in the U.S. So there's lots of good stuff that, that you've done. And I think that's what a diversified portfolio is about. You're never going to pick kind of every great stock, but it's really about sort of taking the responsibility and making sure that we manage in a responsible way so that we're not betting on one thing. And I think you guys you've done a great job doing that, and I continue to support you and think that keep it up. You know what? Gold may have gone up. Maybe we'll pick something later, but there's always a time and a place. So great work, and thank you very much for a great little talk here. A good job in terms of your questions. I think it was really entertaining. And I'm going to give you my last sort of word here, my Netflix recommendation for your viewing, which is coming up. Probably would be a show that I've seen a series with Sarah and I. We watched Hostages. I think it's probably a 6-part series. It's on Netflix. If you want something to do at night, there you go. So have a great evening, and thank you for joining all of us. Really appreciate hearing and listening from you. You got any questions, please send it to us. Happy to talk to you guys about it personally. Thanks again.